today's video, we're going to learn about futures margin. If you're new to derivatives, take a look at my other videos explaining what derivatives are, what futures are, how futures are priced, and so on. Subscribe to the channel if you'd like to learn about other derivatives like options, swaps, credit derivatives, and so on. These videos are all based on my book Trading and Pricing Financial Derivatives, which is available on Amazon.com. If you're really interested in the topic, it might be worth taking a look at that. It's also available at a lot of university libraries. There's an Amazon link in the description down below. Okay, so let's dig into today's topic, futures margin. The term margin refers to money that's used to buy securities. Buying securities in a levered manner is usually referred to as buying on margin. The amount of margin posted refers to the amount of equity contributed by a customer as a percentage of the current market value of the securities. So if you only have to put up, say, half of the money necessary to buy the securities you're buying, we refer to that as a 50% margin requirement. The reason that exchanges and counterparties demand margin is to minimize credit risk, which is the risk that you'll be unable to pay them in full. Typically, traders must post margin or a liquid bond, which is sometimes referred to as a performance bond, of between 5% to 15% of the contract's value. Futures margin rates are set by the futures exchanges. Sometimes brokerages will add an extra premium to the exchange minimum rate in order to lower their risk exposure to a particular client. Margin is usually set based on risk. The larger the dollar value moves that a futures market commonly makes, the higher the margin rates will be for that contract. To minimize counterparty risk to traders, trades executed on a regulated futures exchange are guaranteed by a clearinghouse. I have another video that will explain what clearing is. That's coming out, I think, tomorrow. Margin requirements are there so that traders can transact with each other without performing due diligence on each counterparty that they deal with. This allows for an orderly market with greatly enhanced liquidity. Margin requirements are reduced in many cases for hedgers who have physical ownership of the underlying commodity, or for spread traders who have offsetting contracts, balancing and thus reducing the risk of their positions. There are a few different types of margin. The first one is initial futures margin, and that's the amount of money that's required to initiate a buy or sell position on a futures contract. Initial margin requirement is calculated based on the maximum estimated change in contract value within a trading day and is set by the exchange. Then there's margin maintenance, and that's the set minimum margin per outstanding futures contract that a customer must maintain in their margin account. So for example, we'll suppose that the margin on an oil futures contract is $100 and that the maintenance margin is $70. If you buy 10 oil futures contracts, you'll need to put up $1,000 to start with. That's 10 contracts times $100. And that'll be set aside as initial margin. If the price of the oil drops such that you lose, we'll say $300 or more, you'll have violated the maintenance level and you'll need to add funds to bring it back up to the initial maintenance level. So maintenance margin is usually a little bit lower than initial margin, usually to give investors a little wiggle room before having to top up their accounts. So what is a margin call? Well, apart from being a 2011 film that's fairly obviously about the meltdown of Lehman Brothers, the term margin call is a term that traders have nightmares about. A margin call on futures contracts is triggered when the value of your account drops below the maintenance level, and it involves the broker asking the client, who might be either a hedger or a speculator, to deposit sufficient funds into their account to maintain their trading position, including maintenance margin. So what that means is that you've lost probably a significant amount of money. The fact that your account is under margin means that you're kind of a risk to your clearing firm, and so they call you up and say you have to top up your money. You usually have to top it up right away, so it's not you don't sort of wait 3 days. You either get the money into your account that day or they close out your positions. Okay, so hopefully that's all you need to know about futures margin. Do take a look at my other videos on financial derivatives to learn more. Coming up in the next video, we're going to learn about how the futures clearinghouse works. Hopefully you enjoyed this video, so please hit the like button and tell your friends about these videos. Make sure that you subscribe if you'd like to see more of this type of video. And equally, please comment below if there's a topic that you'd like me to cover that I haven't done a video on yet. Have a great day. Bye.